If you have $20,000 saved right now, you're standing at one of the most important financial crossroads of your life. That money is either the beginning of real wealth or the beginning of going right back to zero. And most Americans choose the wrong path. Nobody talks about this moment. They talk about getting out of debt, they talk about investing, they talk about side hustles, but they don't talk about what happens psychologically when you finally hit a meaningful savings number. Because saving your first $20,000 changes you. You stop feeling broke, you stop feeling behind, you start feeling stable. And stability creates a dangerous emotion: entitlement. You start thinking, I worked hard for this, I deserve something better. What's the point of saving if I don't enjoy it? And that voice, that quiet, reasonable voice, is exactly how wealth disappears. Here's the truth. $20,000 is enough to feel powerful, but not enough to actually be financially secure. It's the illusion of security, and illusions are expensive. This is when lifestyle inflation creeps in. You upgrade the car, you upgrade the apartment, you book the vacation, you finance the furniture. Nothing crazy, just a little better. But here's what most people miss. Small upgrades create permanent monthly expenses, and permanent monthly expenses destroy long-term wealth. Wealth is not built by what you earn, it's built by what you don't permanently commit yourself to spending. Before you invest a single dollar of that $20,000, you need to ask one simple question. Do I have debt above 7%? Credit cards, personal loans, buy now, pay later balances, private student loans. If you're paying 18, 20, 22% interest, that is not a small problem. That is financial bleeding. If you owe $10,000 at 22% interest, you are guaranteeing a 22% loss every single year that balance sits there. Meanwhile, the stock market historically averages around 10% long-term. So if you invest while carrying 22% interest debt, you are paying 22% to maybe earn 10%. That is not investing. That is mathematically losing. Paying off high-interest debt is a guaranteed return, and guaranteed returns beat hypothetical ones every single time. It's not emotional, it's math. If this is already changing how you see your money, hit the like button. The more people engage with this, the more YouTube pushes it to people who actually need to hear it, and most Americans desperately need to hear it. Once high-interest debt is gone, now we talk about protection. This is the part people hate. Emergency fund. 3 to 6 months of essential expenses in cash. Not invested, not in crypto, not in stocks, cash. Why? Because emergencies don't care about your investment strategy. Your transmission fails, you lose your job, medical bill shows up out of nowhere. If your entire $20,000 is invested and the market happens to be down 20% when you need the money, you are forced to sell at a loss. Or worse, you swipe a credit card and go right back into high-interest debt. One emergency can erase years of discipline. Keep your emergency fund in a high-yield savings account at reputable banks like Ally Bank or Marcus by Goldman Sachs. It won't make you rich, it might earn 3 to 4%, but that money isn't there to grow. It's there to protect you from going backwards. Staying in the game is more important than swinging for the fences. Once debt is eliminated and your emergency fund is solid, now we build wealth. If you qualify based on income, one of the most powerful tools available to Americans is a Roth IRA. Always check the contribution limits directly on the Internal Revenue Service website because they adjust over time. Here's why the Roth IRA is so powerful. You invest money that's already been taxed, but every dollar it earns after that grows completely tax-free. Not tax-deferred, tax-free. If you invest $7,000 at age 25 and it compounds at 10% annually by retirement, that single contribution could grow into hundreds of thousands of dollars, and you don't owe taxes on the gains. Now imagine contributing every year for 25 or 30 years. That's how ordinary middle-class Americans quietly become millionaires. Not by predicting the next big stock, not by timing crashes, not by chasing hype,
by consistency and tax efficiency. Inside that Roth IRA, do not overcomplicate this. You do not need to research individual companies at midnight. You do not need to watch financial news every day. Buy broad indexed funds like Vanguard S&P 500 ETF or Vanguard Total Stock Market ETF. These funds give you ownership in hundreds or even thousands of companies with extremely low fees. You are not trying to outsmart Wall Street. You are partnering with the long-term growth of the American economy. Your job is simple. Invest consistently and don't interfere. Let's talk about what that consistency actually does. $20,000 invested at 10% for 30 years becomes roughly $350,000. Add $500 per month consistently over those 30 years, and you're looking at over $1.5 million. That's not fantasy, that's compound growth over time. The difference between someone who retires stressed and someone who retires comfortably is often just disciplined repetition. Now we need to address the biggest silent wealth killer: lifestyle upgrades. A $400 per month car upgrade invested instead at 10% for 30 years is close to $800,000. A $500 apartment upgrade, nearly $1 million over decades. That small monthly decision isn't small. It's a future retirement decision. Most Americans don't stay broke because they don't earn enough. They stay broke because every raise turns into a new payment. They upgrade faster than their investments grow. And here's the uncomfortable truth. The car that impresses your coworkers will not pay your bills at 65. The apartment that feels luxurious today will feel normal in 3 years. But the money you invested instead will quietly keep compounding in the background. If you want to build real financial freedom in America, subscribe to the channel, because we're not chasing hype here. We're building systems that work long-term. Your $20,000 isn't just money, it's leverage, it's time, it's opportunity, and what you do with it over the next few weeks will echo for decades. Be patient, be disciplined, be boring, and let time do what it has always done. Reward the people who don't interrupt compounding. That's how $20,000 becomes financial freedom.